It's Wednesday, the 24th of March, 2021. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Sean Aylmer. The floods in New South Wales and southeast Queensland have triggered a crisis that could cost as much as $2 billion. That's our main story. Also coming up in today's podcast, the Prime Minister tries to salvage the government's reputation over the treatment of women. James Packer says he'll follow the lead of the Crown Board in response to the $8 billion bid for the gaming group. And one of the year's most anticipated floats finally hits the ASX. Later in the podcast, I talk to Marnie Baker, Managing Director of Bendigo and Adelaide Bank. But first, here's a brief look at markets. In early afternoon trading, both the Dow Jones Industrial Average and S&P 500 on Wall Street were flat. The Nasdaq 100 was 0.3% higher. European markets were mixed, with the Stoxx Europe 600 down 0.1%. The S&P ASX 200 closed yesterday down slightly to 6,746 points. The tech companies, energy businesses and travel stocks all underperformed. Telecommunication stocks did best, followed by utilities and healthcare stocks. Telstra was easily the best performing large cap, up 2.5% after its announcement on Monday about splitting the group into 4 divisions. Industrial property group Goodman was 1.7% higher, while BHP and Fortescue Metals both closed up 1%. All the big banks fell yesterday, led by ANZ. Afterpay was off more than 2%. Yesterday marked the 1-year anniversary of the lowest close of the S&P ASX 200 during the pandemic. The index closed at 4,546 points on March 23 last year, and since then, it's up 48%. Oil prices tumbled overnight by as much as 5% as a new wave of coronavirus infections hit Europe, dampening hopes of a swift recovery in the region. Also worrying investors was the spat between China and other Western economies over human rights abuses. China is the world's largest importer of oil. Gold prices were lower overnight, while the Aussie dollar is trading at 76.6 US cents, down sharply over the past 24 hours. It seems the currency has fallen in line with the drop in the New Zealand dollar, following changes to tax laws in that country. More of that in a moment. Also working against the local currency are expectations that demand for iron ore from China will fall. Australian insurers have received more than 12,000 claims, with many more to come as the floods hitting the mid-north coast of New South Wales and Western Sydney continue to cause havoc. The Insurance Council has declared the floods a natural disaster, and they've already had a massive impact on retailers, miners, travel companies and insurers, among others. As river levels rose, 20,000 people in the state were ordered to leave their homes, while tens of thousands of others were on standby. Whole towns were evacuated on the north coast. The Australian Defence Force was deployed to help with evacuations. Around 280 schools were closed yesterday. But last night, severe weather warnings for Sydney were cancelled, but the south coast of the state is now in the firing line. With the human crisis hopefully having peaked and people soon able to return home, the cost to business is now being calculated. The 3 main players in the general insurance market in Australia are IAG, QBE and Suncorp. Analysts said that floods tended to cost insurers less than other types of natural disasters such as hailstorms, cyclones and earthquakes, but this downpour is a 1-in-50-year event. Macquarie Group analysts said the largest flood loss ever was $2.4 billion in 2010. Market analysts aren't forecasting that level of loss, but said it could match last season's $2 billion in bushfire payouts. The floods sent listed travel stocks much lower yesterday as people rearranged holidays. Sydney Airport was down 2%. Corporate Travel and Flight Centre both fell 4%, while Webjet was 3.4% lower. Qantas dropped 2.3%. Coal prices surged to a 29-month high in the back of the storms in the Hunter Valley in New South Wales and delays at the port of Newcastle. Vessel movements were down about 1/3 over the weekend, while the Australian Rail Track Corporation temporarily ceased operations through the Hunter Valley network. New South Wales-based Whitehaven Coal yesterday cut its earnings guidance for this financial year due to delays at the port of Newcastle, and retailers Coles and Woolworths said more than 6 stores had been impacted and were closed. In coming months, the full financial cost of the floods, the worst in decades, will emerge. Estimates sit between $1 and $2 billion. Bushfires, COVID-19, floods. It's been a tough 18 months for New South Wales. In a moment, the rest of the news you need to know this morning. In overseas news, German Chancellor Angela Merkel has put the largest economy in the region into lockdown over Easter to try and diffuse another wave of coronavirus infections. Meanwhile, the World Health Organization Director General overnight said the recent increases in the number of COVID-19 cases was worrying, and the vaccine rollout was inequitable, favouring rich countries. China and Russia said they'll work together against sanctions from Western countries and cooperate more closely to make their economies less reliant on the United States. Historically, the two countries have been anything but close, but now both have come under pressure from the new Biden administration. Yesterday, they said they'd work together to oppose Western aggression. New Zealand will spend almost $4 billion New Zealand dollars to boost the supply of houses. The government has also reduced tax incentives for property investors. Both are in response to surging prices across the country in recent months, and that triggered a fall in the New Zealand dollar. Media reports suggest that President Joe Biden's economic advisors will recommend a $3 trillion package to boost the economy, including programs to reduce carbon emissions, narrow economic inequality, and boost infrastructure spending. Part of the money will come from tax increases on corporations and the rich, according to the New York Times. And WeWork, which wants to list on the New York Stock Exchange, lost $3.2 billion last year as COVID-19 shut down many of its co-working spaces around the world, according to the Financial Times. But last year's result was better than 2019, when it lost $3.5 billion. Locally, former Prime Minister Malcolm Turnbull said the thuggish, blokey, sexist and misogynistic culture in Parliament House in Canberra would continue until ministers and staff took accountability for their actions. Mr Turnbull famously introduced a bonk ban, and he said standards had slipped under the current Prime Minister Scott Morrison, and there was no leadership on the issue. Mr Turnbull kept swinging. He said he was disappointed with the PM's comments on the sexual harassment of women and claimed Mr Morrison spoke too much about himself and not enough about the victims. Mr Morrison is clearly getting sick of the discussion. He called for anyone with information on prostitutes being brought into Parliament House to come forward, and when asked a question by a Sky News reporter, he said he'd heard allegations about harassment at the reporter's place of work. Late last night, he issued an apology for that comment. The PM has done a poor job handling this issue. Yesterday, he tried to recover, backing the introduction of quotas to boost the number of female MPs in the Liberal Party. He also wants to introduce mandatory health and safety training for political staffers. Mr Morrison seemed to lessen his support, slightly, of Attorney General Christian Porter, who has been subject to allegations of rape 33 years ago, allegations he vehemently denies. Mr Morrison said he was considering advice on whether it sits within ministerial standards for Mr Porter to remain as Attorney General. The PM looks rattled on this one. James Packer, the 37% shareholder of Crown Resorts, yesterday said he would follow guidance from the Crown board on whether or not to accept the $8 billion takeover bid for the gaming giant from US private equity group Blackstone. Mr Packer's vote will decide whether Blackstone will buy Crown, and some analysts expect it will be a drawn-out process, with at least one other offer tabled before a deal, or otherwise, is done. The easing of pandemic-related restrictions across the country continues. The Victorian government yesterday said offices will return to 100% capacity and AFL football crowds will be increased to 75%. The mask mandate in retail settings in the state would also be removed. Victoria had no active cases yesterday. It's the first time that's happened since mid-December. AGL Energy is pushing ahead with plans for a massive battery to be installed at its Loy Yang power station in Victoria. It will be part of a network of storage systems to help eventually replace coal-fired power plants. AGL has lodged a planning application for the project. The group has also announced plans for batteries in the Hunter Valley and Broken Hill in New South Wales and Torrens Island in South Australia. It was the long-awaited stock market debut for Airtasker yesterday, which finally hit the bourse 24 hours later than scheduled due to a hitch at the ASX. On opening, Airtasker's share price jumped 75%. Pushing its market capitalisation beyond $400 million. It was the third largest initial public offering this year, and the stock eventually closed at $1.05, up from its issue price of 65 cents. Sigma Healthcare announced a better than forecast underlying profit for the 6 months to the end of January. Sales revenue was up 5%, while net profit after tax was $60 million, up from a loss 12 months ago. Chief Executive Mark Hooper said the group had navigated the challenges of the COVID-19 pandemic and would achieve earnings targets over the next 2 years. He said the company was on the hunt for acquisitions in the medical consumables and devices space. The Australian Securities and Investments Commission will allow online-only shareholder meetings, even though the rules allowing them will shortly lapse. During the COVID pandemic, almost all listed companies reverted to holding meetings online, upsetting some shareholders. For companies, the cost and time savings were significant, though they didn't allow shareholders as easy access to ask questions. ASIC yesterday said it would adopt a no-action position in relation to the convening and holding of virtual meetings. In other words, it will turn a blind eye. Coal miner New Hope said it lost $55 million in the first half of the 2021 financial year, reflecting much weaker prices for coal as well as lower volumes. Revenue was down 34% and earnings were 62% lower. Rio Tinto said it will set up an Indigenous advisory group to ensure the mining giant better understands First Australians' cultural issues. The group is also reviewing cultural management heritage at mining sites. It follows the explosion of 46,000-year-old sacred sites in the Yukon Gorge in Western Australia last year. And finally, retailer Kathmandu said it won't repay government grants and wage subsidies worth around 20 million New Zealand dollars that helped the outdoor leisure retailer increase January half earnings. Pre-tax earnings jumped 42%, and the group said it would start repaying dividends. As I've said many times now, the banks have played a vital role during the pandemic and the recession over the last year. They've acted as a shock absorber for the economy, working with business and home loan customers to help them get through the tough times. It's a reminder of the hugely important position they hold in Australian society. Bendigo and Adelaide Bank is the fifth largest retail bank in the country. Marnie Baker is the Managing Director of the bank, and I'm pleased to say my guest this morning. Marnie, welcome to Fear and Greed.
Thanks, Sean. It's a pleasure to be here.
The most recent reporting season, you had one of the best results of anyone. Revenue had jumped. Your cost-to-income ratio for banks, all important, had fallen significantly. You had a big drop in bad and doubtful debts, much better performance on costs. How do you do that during a pandemic?
We've been very focused, Sean. Look, we were well placed coming into COVID, well capitalised, a strong, resilient balance sheet, and sort of good business performance. But I think something like COVID does give you that impetus to even more focus on the things that actually are important to the organisation. And I'd come into this role 2.5 years ago, and we had just embarked on a strategy that saw us reducing complexity in the organisation. Over 162 years, there had been some complexity that had built up, but also investing in capability just to take that next step change that we were looking for in our organisation, and probably telling our story a lot better than we perhaps have done to date. And you touched on that earlier when you asked me the question that perhaps some people didn't have a background of who we are. So it was a strategy that we employed. COVID came about and we needed to just revisit that and make sure that it was still solid and sound, and we found that it was, with a little bit of resequencing, of course. But we have embarked on a pretty ambitious growth and transformation strategy that is, as you could see by our results, our most recent results, is actually, we're very pleased that we're actually getting the outcomes from the focus and the effort that's being put in by the organisation.
So one thing I think the banks did incredibly well last year, and everyone loves bashing banks, but I don't think the economy would be where it's at today if it wasn't for the banks. Obviously, the big four, yourself, Suncorp, some of the smaller guys around as well. And the thing that I think was really critical was the ability for the banks to allow customers to freeze their loans, and we still have to pay them back, so that's all fair. But the banks could actually withstand the shock better than the individual could withstand the shock, or at least it was shared. In the mortgage market, how many of your loans were frozen, and then where are you up to now?
Yeah, I think it's important just to be clear that the loans weren't frozen. We, like the whole banking industry, did. So it wasn't just the few larger banks, it was the whole banking industry. We got together and made that decision, and that was in conjunction with the government and with regulators to ensure that we were able to do it in a seamless way. But we provided a holiday period, so where customers could defer their interest and principal payments on their loans whilst they managed through the uncertainty on their lives or their businesses through the COVID period. So it was a holiday period rather than being frozen. I think it's really representative of how you can come together as an industry, all focused on the outcome of ensuring that Australians are able to get through this period of time, because we all didn't know what we were really facing into at that point in time. So, it took a concerted effort. But the number of loans that continue to be on deferral arrangements has come down steadily, and especially of more recent months. And it's dropped from our peak in our organisation in mid-2020 was around $6.9 billion in value of loans that were on these deferral arrangements. And it's come down over 90% since then to now less than 1% of our total loan book. That's as at the 31st of January, which is the latest update that we've made to the market. And since then, of course, has come down even further. So we're really pleased.
You are in an incredibly competitive sector, and we've seen that Westpac is white labelling deposit products for Afterpay, the Buy Now, Pay Later group. How do you keep ahead of that competition?
I think it goes back to what I was saying before, Sean, around really listening to your customers. It is interesting. I'm a big advocate for the fintech sector. I do like to see where innovation is coming in. A lot of these, the Buy Now, Pay Later, a lot of the other fintechs that are honing in on a certain part of the customer experience and doing it really well and preempting what customers are looking at. And that's where you get great innovation, and that's where it actually lifts the bar, across the whole industry. A lot of people are focusing on the Buy Now, Pay Later, but if you think about it in the sense of, ATMs and then, FPOS changed the way that they access cash. So this is happening all the time, this sort of evolution, and now you're seeing a Buy Now, Pay Later that's stepping into probably the credit card market there. And you'll continue to see more innovation and evolution, I'm sure, as we move forward. And it's something to watch really closely.
Marnie, thanks for talking to Fear and Greed.
Pleasure, Sean. Lovely to meet you.
That was Marnie Baker, Managing Director of the Bendigo and Adelaide Bank Group. If you'd like to hear more of my chat with Marnie, it's available right now as bonus content. The Bendigo Bank story is an interesting one. It's a bank that's become part of the community for so many towns and regional centres across the country. In my full conversation, Marnie explains how the profits are split with those communities and how the decision is made to close branches when necessary. You'll find it in the Fear and Greed playlist. Canberra will certainly be interesting to watch today. The PM is feeling the pressure over how he's responded to allegations about behaviour in Parliament House and generally his response to the treatment of women. He normally doesn't wait too long before acting to try and change the narrative. It's Wednesday, the 23rd of March, 2021. I'm Sean Aylmer, and that was Fear and Greed. Enjoy your day.